All right, guys, welcome back to the Market Delta Footprint Deep Dive. This is Anthony Drager. We're going to do part 2 of this footprint tools, patterns, and setups. Part 1 was done by Trevor, and this is actually one of my favorite videos to do as part of this deep dive because it brings everything together, and I think you guys will really like it. So when you're going through the agenda to kind of get a sense of what I'm going to talk about today, we're going to pull everything together and reinforce the application of the concepts, which is what makes me, excited about doing this. We're going to list out some core tools. We're going to list out some key patterns and setups to keep it organized and simple, show some examples, kind of go from there. Then I'll also go to a chart and pull out some from there so we're not just looking at images. Some footprint strategies. They're consisting of the tools that you learn. That's why I like this video, is because we're bringing everything together, taking the tools from the footprint and showing them over patterns and setups to create that qualifying moment. Identifying a pattern or a setup and then executing it with one of these tools. Again, identify this pattern, then qualify. Identifying is the pattern or setup, the recognition of that, and then the qualified is the tool that we discussed at some point during this deep dive program. Some of the tools, which are what we like to say the techniques used to qualify a setup or pattern and then execute it with better precision. Most people's weakness is pulling the trigger. In that ready, aim, fire progression, as I like to talk about it, most people don't know when to get ready, aim, and then if they do, they have trouble with the fire portion of that ready, aim, fire progression. You got to have better tools to address the weakness of execution, which is pulling the trigger, knowing when to get long, when to get short, when to blow off support, when to blow off resistance. Disqualifying a particular setup is just as important as qualifying it. Some order flow tools that I'm going to talk about with the green X next to it are going to be all the top 4. Imbalanced triggers here at the top, the filter, some thin spots, delta profile magnets that I want to cover. I could do a whole video just on delta profile magnets. Cumulative delta is what Trevor covered in part 1. This is a cool slide. Tools on the left, patterns and setups on the right. What's cool is, and this isn't science, but the imbalance trigger to begin to show when to, maybe if you follow the green line over, to execute a delta divergence, or an imbalance trigger to execute a naked POC, or take it down to find a higher high or a higher low in that particular pattern of when to get longer, when to get short. You look at the filter, and you could talk about using the filter to execute a head fake, and so on. So this is a really cool slide to not only look at and use as part of your education in this program, the deep dive, but build your own out. What is going to be the setup you like, the one that you might even have came up with, or a pattern, and then what are you going to use to execute it? Really important in coming up with your plan. Forget about this, trade your plan your trade. I mean, that's all well said, but just get into the simplicity of what the heck are you looking for after you found your particular pattern. What's next? Some of these patterns and setups, there's a lot of different ones. They're all benefiting from these order flow tools, okay? Some are very discrete patterns. Some are chart patterns. Others are more broad, like a trending market, all right? All different kinds of reasons to make a pattern a pattern. They all could lead to some sort of reversals. That's what I like. I call them B2B moments. Again, that's a whole nother video I could do, but B2B moments are bearish to bullish, bullish to bearish moments that a market changes its mind. So the green X, what I'm going to talk about, what I call long up-down bar, delta divergence is what Trevor had spoke about. Let's go into long up-down bar first, all right? What's important in this? And I've got all the arrows and such all set, but I'm going to throw a pen on it to just give you more clarity. Like we've gone over in every video that I do, and that is up bar, down bar. If you're watching a bird in the sky, this is how your eyes better fixated on this particular chart. All right, up bar in this green arrow, down bar in that red arrow. And then all of a sudden, what we get is a thin spot. We get the market to pick up the pace with a nice thin spot on the way down, creating potential resistance at this dotted white line. to find a place to potentially get short to find this downside. Now, this is just an image of a particular move, but you got to understand the dynamic behind it. This is the pattern. Just focus on these two bars in order to predict the rest and build out that story. When you get a market that jumps in price, I'm almost going to guarantee that you get most people to say what? Before they see anything else in here, what do you get them to think when you see a big jump in price? Boy, I wish I would have bought it, or I'm bullish now. All right? I often call it the fifth grade mentality. Something that's just obvious. They're going to say, yeah, let's buy it. All right? And that's fine. They could buy it. Sometimes it works. Maybe they buy a retracement to there or buy a retracement to there. All along the way, they're wrong, as it turns out. So when you get side-by-side bars that quickly retrace themselves, you get a transitional moment. In this case, from bullish, when all the fifth graders and retail audience thinks, okay, let's buy it. All right, this was my trigger to buy it. It already went up. And they get stuck. It's only going to be when people get stuck that's going to qualify high probability type trades. That's the word you want to focus on. Trap, stuck, same thing. Where do traders get trapped? If you're not looking at, when you look at patterns, I'll put it to you this way. When you look at patterns, you want to understand and explain the dynamic of that pattern and make it a pattern that's going to show you potentially a transitional moment where early on you could predict the market just changed direction. I like to call it the market's opinion. I want people, especially people that come and have invested in us, in our educational programs, whether it's this deep dive or some other stuff, to not worry about what your opinion is. Don't worry about what Anthony's opinion is, what Trevor's opinion is, what some other educator's opinion is, or what your opinion is. I want people to focus on what the market's opinion is. What that's going to do for you from a psychological level is give you an easier opportunity to change that opinion because it's not yours. Think about it. Once you put your opinion out there, it's hard to change it because it's your opinion. We get married to it. The market's telling us what it thinks. Walk along with it no matter what your time frame is. Walk along with it. This happens to be a 4 P&F. But what's the market's opinion? And before I see the rest, I'm looking at a long up down bar and I start to get bearish. And when you see a good pattern, you're going to get bearish before most of the rest of the market. It's easy to get bearish once it's way down there. But how about getting bearish when it's just totally retraced an up bar? It totally went from bullish to bearish in a very short period of time. That's potentially a transitional moment. So if you're bearish because of this pattern, now what? You've found the opinion of the market. It's bearish. Well, what next? You can't just sell it. You got to look for a location. Most importantly, where I'm wrong, if I'm short and wrong, probably close to the top of that bar. You don't want it to run all the way back up before you say you're wrong and have too much risk. And then you look for a thin spot within the down bar, within this red arrow bar that I have, to take a shot. Going back to rotation, you're looking for the rotation to come up and slide back down. This 2-bar sequence, in this case a long up-down bar, showed you potential bearishness in the market. Maybe you're also bearish for another reason. And that's what's really cool about these tools and these patterns. Say you're bearish for another reason and you're waiting for the timing to get short. You see the pattern, bullish to bearish. You could accurately assume people are stuck what? Stuck long because they were bullish in this bar and they got clipped on the way down. Now they're sellers trying to get out. And all that selling creates the definition of real resistance. And then you take all of that and you say, not only is it resistance, but it's real-time resistance. That's more important because this isn't a particular area of prices where every Joe Schmo is going to get short because they did their homework, and that's where it said to get short based on stuff that happened over the last 5 days or 5 weeks. While some might be good at analyzing the past to predict the future, you guys are going to get good, if not already much better, at understanding the present. There's a big void in people's toolbox and skill set in understanding and reading the present. It's a big part of what order flow is. Pattern recognition in real time of transitional moments, being able to explain that to someone else, bullish to bearish, place to get in, and a place to assign your risk. So that's the long up-down bar as explained by this image as a transitional moment. Trending patterns and setups. These are patterns which could lead to continuation of a trend. Unfinished auction, which is what Trevor covered, higher highs, lower lows, which is what the pattern looks like in an uptrend, is what I'll cover. Naked POCs is, again, what Trevor covered in part 1. 2 images. Real simple uptrend pattern. Here's a big problem with trading a trend. Oftentimes when you recognize a trend, it's too late. A trend isn't your friend. That's only a phrase and cliche because it rhymes. Most people recognize a trend when it's too late and it's up there. You should have already been able to buy it. But if you're expecting a trend, and usually people don't often have this in their definition of a trend, you'd like a fundamental driver of it. Whether it's an economic number that the market wants to see to be bullish and you got it, whether it's a fundamental piece of news, maybe it's a geopolitical event, something that you know could have some long-standing effect into price throughout the duration of a session or a week or a month if you're a longer time frame. When you begin to see simple higher highs and higher lows, what you get here, and look at this simple image on the left here, these 2 red arrows, higher highs. Here's a high that you distinguish and you say, this is a higher high. Where the heck could I get in because I anticipate this happening? You're going to have to have a sense of what a trend should look like if it's going to work, right? It's going to help you get out when you're wrong, but it's going to help you stay in when you're right. What's the pattern supposed to look like? Well, on a trend, just look over here at the right. A trend should look like that, right? A high made, a higher high made, and so on. A low put in, swing low, a higher low put in, and so on. All right? Well, this yellow bar chart here on the left shows that. Why did I circle this green? If you take this image and you blow it up and then look inside the bars, look inside the charts, which is the tagline of the footprint and market delta, it's going to bring you to this bigger green circle, okay? The word support. Why is that support? Understanding thin spots where the market picked up speed, where it showed a little less volume behind, was inside this green circle. Look at all these greens and how fast this market ran up. Remember, this is a blown up image of all these candles, or in this case, bars on here on the left, right here. Inside this green circle should be support, and the market runs back up. I'm not just pulling a great image that you see. I'm pulling, if you're expecting a higher high or a trend to stay intact, how do you get on sooner rather than later? Because the trend is not your friend. Most people start trading a trend when it's too late and they should have already been in it. When you're looking at an uptrend, which is this image, what you're looking for is places to buy it. You're playing the market from the long side. I could care less if this didn't work. In fact, I'd rather it not work for example's sake. Why? Because if I could show you good support to get on board of a trend, I could show you a better place to get the hell out of it if you're wrong. And that's underneath it. Again, that's an important part of good support or good resistance, in this case support. Where to get out of a long trade if it's good support underneath it, not one tick. You adjust how far underneath support you're going to get out for a loser based on what your risk or based on how much you're trying to take out of the market. If you're expecting a move several points higher, that doesn't mean you risk several points, but you're going to have to be a little bit more liberal with what you risk. So in my opinion, it's not about this is a great spot to make money and have it go up, but it's a better spot to also say where I'm wrong below. Exits before entries. pattern recognition of what a trend might look like by higher highs and then higher lows. There's a low, and then there's the next sequence. Where could this retracement get stalled? Come down, come in. Simplicity. Understanding some of the earlier videos and tying it in to a pattern and trading this particular trend. Breakout patterns and setups. So we went to reversals, to trends, to breakouts. Where the stop started is what I like to call it. Head fakes is the other. There's a lot going on this chart. What's the first thing that we want to review and make sure we know? Bird in the sky. You should always be able to draw this pen through it with your eyes. Down bar, up bar, down bar, up bar, okay? First thing that you recognize is, what do I mean about where the stops started? What do I mean by that? When you usually get the market to move fast, like it does inside this red rectangle here, okay? It's generally a collection of a lot of selling and a lot of stops that came out of the market, which sped it up. Anytime you get sell stops, in this example, that have come out, you also get that dynamic of a lot of people that wish they would have sold it, either to get in for a winner on the downside and get short, or get the hell out of their long, and yet they didn't, and they had to realize all this extra pain. This white swooping arrow is extra pain. I do a story, I'm not going to do it in this, I don't think I've done it in this program, but the baby bird story. Helpless, baby birds are helpless, so are people in losing positions dying to get out. Using this thin spot, like I've talked about in previous videos, we talk about how in this area could be really good subsequent, that was a bad line that I drew, really good subsequent real-time, in this case, resistance. If you could start identifying with these areas, and in future videos of this program, we're going to even have better visuals. But I want you to understand the dynamic of why this would work before the how. And when you see a stacked instance, seller, 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 and the market picks up some speed, and you could assume stop started there, you usually get really nice resistance that comes in. Because longs wish they would have got the hell out. What are longs doing all up in here or on this line? They're all trying to sell it, and the market can't get through it. And then what happens is all these X's that represent sell orders, once the market can't go, they just jump down and say, to hell with it, I'll sell 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 it. And they end up keeping pressure on the market. And that's the definition of why resistance is resistance. Sellers that have to get the hell out and they're emotional finally say the heck with it, push it down, jump, 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 and race it lower. Remember this fact. Markets don't move because people get into positions. They move because people are trying to get the hell out of positions. That's where all the emotion is going to come from. Not where people get in, it's where they need to get out. If you're in a trade, whether it's a winner or a loser, especially if it's a loser, what happens when you're trying to exit a losing trade? Are you emotional? Of course you are. Well, where could you find on charts where others might be emotional? What direction are they emotional in? Are they buyers or sellers? If they're sellers, it's resistance, and if they're buyers, it's support. If there's enough collected in a certain area, it's great resistance. If enough collected short in an area, it's great support. Longs who are nervous represent resistance. Shorts who are nervous would represent support. What are longs after they're long? Sellers. What are shorts after they're short? Buyers. What do you need for resistance to be resistance? Sellers. And a lot of them trying to get out. Here's what also is great about the definition of resistance when you have it right. They're not sellers to get into a position. They're sellers to get out of a position. So once they get filled or execute, they're done. They're out. If they were sellers to get into a position, then they turn back to buyers, which isn't necessarily good for more downside. When you get someone to sell and they turn into a short, now they're a buyer and they're somewhere below the book, and that could create support. But when you get sellers because they're exiting a position, they sell it, they're not a buyer. They were exiting a long trade. That has to make sense to you because it goes deeper into the definition of a resistance. I'd rather have people trying to sell an area to get the hell out of a stuck long trade than to get into a short trade. Resistance will work a lot better when the dynamic of people exiting a long trade exists over people trying to enter a short trade. Markets move because people exit. And when they have to exit, they even move more violently. The other thing to remember with the movement of a market is when a market goes up, let me erase some of these illustrations. When a market goes up, it's not because people bought it. It's because people are trying to buy it and they can't get filled. That's why price moves up. In the price of anything, by the way. It could be the price of a house. 3 people are bidding on a house. Only one's going to get filled, but the other 2 are instrumental in the price going up, weren't they? So it's not people who buy it. It's people who want to buy it and they can't get filled. Who better than shorts that are stuck? They want to buy it because they have to buy it. Another metaphor example I give is sitting across the table from a divorced couple if I'm buying a house. That's who I want to be sitting across from. Why? Because they hate each other. They're emotional. They just want out. They're emotional sellers. Where's price probably going? Down because that tired dynamic exists. So you recognize a move before you know any of this. You could assume there's good resistance in that area because you recognize that. Thin spots in the footprint. The name of this pattern is where the stops started, where the breakout broke out. Head fakes. This is a really, I won't say common pattern, but it exists in all markets. On the right side of this slide is a delta profile I'll cover in a moment. Head fakes, you get a breakout, but it's almost like you get back-to-back breakouts, and one was a fake. I'm going to explain the dynamic and the emotions behind why a false breakout creates the real breakout, and call it a head fake. So if we look at this pattern, inside the white box, the white rectangle, what do we see? A consolidation. You know, I talked about how I want people's eyes to focus on a chart with the rotations. It's important to also focus on consolidation boxes, as I call them, congestions, or the fight. So think about that. Where the heck is the fight? This white box that I'm highlighting in yellow, inside here was a fight. The market didn't know which way to go. Longs wanted to go up. Shorts wanted to go down. There's not enough of an imbalance in this area to move it one way or the other. But what happens when the price begins to show a potential victor, like it does at the bottom here? Prices slip through this box. They come through and they quickly come back in. That's the dynamic and the pattern you want to see. What's important in identifying the box is to get the middle set and to say, you know what? I think there's support down in here. I think there's support down here because these shorts, I want to come in and buy it, that have been accumulated at this price based on our delta profile. But I don't know when to qualify it. Yeah, I could buy it here, take a little heat, a little profit, and then be stuck in here. I don't know about you, but I don't like to be in a trade for a long time. The longer I'm in it, the more likely it's probably not going to work. The more time you're in an investment, the less chance it might have of working if it isn't already, right? If it's just staying around where you got in, that's emotional capital you're spending. Yeah, it might go your way eventually, but you want to time it better. Everybody's timing could be better. That's one thing in what I would imagine is a wide range of experience in this program that people are going to go through it. That there are some people trying to get better, some people never have been good, and everything in the middle, everything in between. But one thing you want to keep working on is location, timing. What pattern, what tool, what platform could give you better timing at your particular setup or bias? The market's biased. The market's bullish, but when? So when I see the price slip through, especially if I'm bullish already, and that just doesn't slip through and keep going down, because obviously it's not a head fake, slips lower and quickly jump back in and come back through the middle of this particular fight. To me, then the top of this consolidation box is in trouble. And the true breakout to the upside is coming. And the true moment of qualifying along has surfaced. Above the middle, risking below the low of that particular head fake. Not only, if you notice, every setup I talk about where you're wrong before I talk about where you're right. My 13-year-old son get out of winners. But he'd probably suck getting out of losers because he hasn't went through the deep dive yet. Every retail trader get out of winners. Getting out of losers is where the skill set's going to come into play. Taking a trade, losing, and not being afraid to take the next one. That's a loser. Next one. Consistency is what I'm after for all you guys. I'd rather you be consistently bad than inconsistently good. Really, I want to see consistency because anywhere you see success, consistency is right around the neighborhood, right next to it. So if you're consistently bad, at least we could say, hey, that setup is no good. Something's off. But if you're inconsistently good, we're frustrated. You don't have much to show for it. You're probably not up any money, and we can't qualify what you're doing right or wrong. But if you're consistently bad, we could say, this ain't working. We're going to have to flip some things around. But boy, when you find something that's consistent, we know you're going to trade it consistently, and that's important. Again, this pattern is of a breakout. Now, why would this pattern work? What's the dynamic? Because that's more important than even recognizing the pattern. Let me walk you through this. So you get into this fight. Anytime you start to see the consolidation box form, above the box, people who are short are going to say what? Holy you know what, right? Above the box, people who are short in here are going to get nervous. Below the box, people who are long are going to get nervous. People long are going to get nervous below, and people who are short are going to get nervous above. Make sense? So let's say the market starts to head down with possible momentum breakout to the downside. What does that do to a certain amount of longs inside this box? It shakes them out. If you get shook out as a long, you're no longer a seller above, are you? You could take that sell order away. Think about your OCO when you have a stop, takes you out of a long. It also cancels your offer above the book, doesn't it? So there's one less seller above. Well, if you get enough people shook out long, and that's what happens when it dips below and then jumps right back, you got enough people who are long to get stopped out. So you just erased or deleted or canceled a bunch of sell orders above. Doesn't it make it easier for price to go up if there's less sellers above? Of course it does. There's another dynamic at play. When you start to break out to the downside, you get people who think it's going down, don't have a position, put one on, and it's to the short side. They see it break out, it comes back, they want to get on it, or they sold it too late of the breakout, and now you just added a collection of shorts. You have less, I'm going to try to write this in here, I'm writing with a mouse. You have less longs when the price dips below consolidation, all right? And then you just picked up more shorts because you got people thinking they missed the breakout and they aggressively sell it. What happens when you have less longs? You have less what? Sellers above. What happens if you get more shorts? You have more what? Buyers. What do you have to do after you get short? Buy it. What do people who were long that just got shook out have to do? Cancel their sell order. If you have more buyers, but yet less sellers, it's easier for price to travel up. In fact, that's the equation that you need for price to go up. More buyers who have to cover shorts and less sellers in this particular sequence who no longer need to sell it. It's easier to go up. That's why this is a pattern that's very important. And if you guys researched patterns in stocks or bought books on stock patterns and everything else, what would you find? You wouldn't find this. You find head and shoulders and bear flags and bull flags and crooked M's and W's and all the stuff that's popular. And people who even understand those patterns couldn't explain to you the dynamic of when they would work. Head fakes, long up down bars. Those are transitional moments from, in this case, bearish to bullish. It's really important. Let me get into the Delta profile a little bit, because Trevor did the Everything Delta, which included the Delta profile. This is a very, very powerful tool to use alongside the footprint. And I'm going to cover this in some detail, but I want to give you the simplistic general outline of it first. And then you could go ahead and build on it from there. But for the most part, when you get a green bump out the profile, this isn't just telling you volume. It's telling you the imbalance of volume. So if over the course of the session, a lot of people sold it versus buying it at that particular price, it's going to be the tallest red compared to the other prices of that session. Okay? So I'm sure there's a lot of market and volume profilers that have taken this course. This is, in my opinion, a much stronger and more powerful profile to watch. It's going to give you much better support resistance because it's going to show you where people could be possibly long or short. If you get a lot of people short in this area, you're going to find eventually a lot of buying to maybe have to cover that short. Then you find a pattern that transitions the market from bearish to bullish. And you have your cue and your qualifying moment. But take a step back a second. Let's say this Delta profile is giving us an area of where shorts have opened up a position. All that means is that there's buyers coming. And where do people, if the market's coming from higher, if you're short, let's say, from below, all right, look at the left side of my screen, and the market rallied against you, you're still short, you're taking a lot of heat. It's happened to all of us. You're anxious, you want to get the hell out. Wouldn't you like to get out as close to where you got in as possible, and maybe even for a scratch or a small profit? Retail guys want to take a small profit because they feel like, oh, I took all this heat, I got to take profit. You should have had your risk identified before you got into the short, so you didn't have to take all that heat. But a lot of people in the industry take a lot more heat than they should. They take big losers and small winners. Happens all the time. But if indeed you were short from this area, as may be shown from the profile, why would the market magnet back to that area and then hold? It's generally a magnet because it likes to go back where there was a flurry of activity, but it holds because people then decide they want to buy it. If indeed the profile is showing you an accurate area of open longs, or in this case, open shorts. There's a couple ways to look at this. When you have aggressive selling, like that's what the Delta profile is showing you, aggressive selling, to the tune of a lot more than any other price in this particular session, okay? It's not just volume. This might be a low volume node in volume profiling, but it's the highest node in this particular session, and it's red. A lot more aggressive selling if you understand imbalances now that you should, because you went through this deep dive and you see a lot more aggressive selling than buying accumulated through this whole session. You could say a lot of people aggressively sold it. But if the market, let's erase some of these illustrations, is higher for the most part, that means there was some really good buying absorption. So you got a cool dynamic. If you've got stuck shorts or longs, because if you're above the market, shorts are stuck and longs are sellers. When you have longs that are sellers because of all the absorption of the selling, why does it want to come back down? Because they're sellers. The market always sells it back down to where a lot of people got long and holds to where a lot of people got stuck short. Think about that and write that down. The market likes to go back down to where a lot of people would have got long and likes to hold when a lot of people got stuck short. So if you have that marriage of open longs and stuck shorts, you're going to have the best resistance. The best support you could find. But also the definition of a magnet. Why is that important? If and when you start to develop good magnets, you just found out the market's opinion. If the price is up here, look at my yellow X, upper left. Price is up there and the magnet is down here, meaning it's below where the market currently is. Are you bearish or bullish? If the market's price is up here and the magnet's below you, are you bearish or bullish? Your answer should be bearish. So if you could get short by another qualifying moment using the footprint as a tool or some pattern up there to get you short, where the hell do you cover? Down in here. The skilled trader isn't necessarily getting long in here. It's covering a short in here. Once they identify good magnets as to where the market wants to go, that's going to define your bias because it defined the market's bias. Replay this video and listen to it because it's a powerful explanation and dynamic of why markets do what they do and why knowing people's open positions is the best tool you'll ever have, ever. And insight to that starts with this delta profile. All right, now let's go to a real chart instead of just images and blow this up, pull all kinds of charts together. This is the S&P E-minis, okay? And we're going to look first to find a delta in these patterns, which is a big one down in here, okay? This was from August the 25th, 2017, in case you want to look back. You know that this delta is down here before all of this selling. So let's rotate the market back a little bit. And this is really great for longer time frame analysis. You're afraid to buy it sometimes because there's a big magnet below. All right? So let's say you want to get short because your magnet is this big red delta profile. Let me shrink this chart up. The price is above. Delta profile could be a magnet that sticks out is below. This is delta profile from one particular session. What's cool is I also got this one from previous session. And then I accumulate the last 5, 10, or 30 sessions. So not only do you have a big one here at 42 even, you got a big one here at 42 half on the 30-day back chart. This is a lot more powerful than volume profiling. If you're bearish up in here for this reason, you could look at trying to find a thin spot to get short after the breakout, like we've been talking about. For instance, take the market and say, I believe this is the top of consolidation. And when you see at the top of consolidation, you're not as surprised as a place to not only get short, but to understand where the hell to get out if you're wrong. Here's a thin spot. You got short in here. You took little to no heat with a head start. You probably get out initially a few ticks higher or above this green delta profile. But this green one has already worked as a magnet because the market went up to there. Now there's a chance it's going to have to go back down to the red one. I'm not trying to give you a setup with 83% of probability it's going to work. There's skill that has to be involved. But the point is, your opinion becomes the market's opinion based on where there might be some open stuck shorts and absorption of a lot of longs in this particular session. And this is into the close. Where do they stick out to give you a bias? It's really important. All right. Now let's erase this illustration and just talk about erasing that one too and go a little further back in this particular session And you can see it's pretty choppy. Here's a long up bar, long down bar, sideways to lower was the next move, although it just chopped and went nowhere, but it retraced, comes lower. This is kind of a dead session. This was on a Friday, I believe. Here's a long down bar, long up bar, sideways to higher was the subsequent move. Here's a thin spot that does not work as resistance. And when good resistance doesn't work, it becomes hell of good support. That's the other thing about good support resistance. Even when they don't work, they're very telling. I'll walk you through this. I'm going to talk more about this. I don't want to steal too much thunder from the Edge Zone series coming up. But you see this nice thin spot, shot down, came back up, didn't work, shot right up through it. Reds followed by greens. Where's the next support for the next several moves? You begin to start to paint the picture of where even a consolidation in a fight might be. This is back here was a head fake. You could see the market. Would this not be a consolidation box right in there? Right? Would that not be? It dips down below it, shoots up through the middle. Sideways to higher was the eventual direction. I go back to the chart because I just want to show that this is what I want you guys to do. You just arbitrarily go back sometimes and say, hey, this is a nice thin spot, should work, and then you come and you see it work. And then go over the times that it doesn't work. So you get confident in not knowing that it's going to work 100% of the time, but that there's a probability factor there. When you get, I think 48 evens in this particular session, and I'm able to talk about it because it just happened. Bullish above 48 even, and then we rally through it. A breakout's coming. And it's like if you ever watch a drama series or a movie and everybody has done that, why do you think they play music? Because they want you to start paying attention. That's what the music is for. They want you to start, it's their cue to let you know when to start paying attention. It's your cue to know when to start paying attention. In fact, if you watched a show and the only times you stripped out everything except in the program when there was some music in the background, you'd understand the whole show. Well, there's no audio in the market, so you got to create that. This consolidation box is going to have shorts inside of here say, holy you know what, when it starts to rally. And sure enough, here's where they say, holy you know what, right in here. This thin spot doesn't hold because then it could get down that far, but this one did. Here's a long up down bar. Sideways to lower was the next. Here's a down bar, up bar. Where's the next direction? Down, up, then it's up. I can go over many examples. What we're trying to do is create that progression of what? The progression of tool, what it is, what it shows you, how it's a order flow mechanic, patterns that you could recognize to find this. Not necessarily moving a market, but a transitional moment. At the time, you knew who the killer was. At the time, you knew who was going to win the game. And if you're good at watching sports, you know where the momentum is, who has it, and when they lose it, right? Well, get good at that when you're reading a chart and watching a market. Transitional moments are when the music was supposed to start. The retail audience never hears the music. Hopefully, now you guys will. There's some really good sessions throughout this deep dive program. This will be one in front of the edge zones, which you guys are going to like. A better way and visual to kind of look at this stuff. You'll really enjoy it. But keep going off the exercises. of going back and trying to identify these patterns as they're happening and not in just one blanket, looking at an entire chart, because it's going to seem easier when you see it. There's one last thing I'll add about real time is that when you look at a chart and you're trying to maybe trade a particular pattern, you've done your homework and went back to look at a particular setup you're working on. One thing to add, and really this doesn't have anything to do with the footprint, but it's a really good element to add to your research, review, your preview, and everything else, is that when you're looking at a setup, you see it after when you're researching it. You already know that it worked. For whatever reason, let's say I'm going to buy it down in here because a bunch of things happened. I like it. Well, you already know that worked. And yeah, you've seen all your different criteria get met. Great. But you also want to measure how long it took. Because in real time, you don't know the result. So you want to do everything you can to keep yourself calm, not super calm, but calmer than most are when they open a position. So you understand this is part of the process. This is how long it takes. You don't want to be long and have the damn market way down here and be calm and say, oh, no, it just takes more time to work. But if you have your stops still in place, you know where your risk is, and it's not maybe working, you want it to work faster, but you know based on what your research was, what maybe the average hold time would be to a particular setup. It's a very important part of creating your plan that most people don't do. And what they do is they set themselves up for a lot of high emotion once they get themselves into the trade. Hope you guys are enjoying this series. We'll see you on the next video.